All right, everybody. So we are going to go ahead and get started here. It is 4 o'clock on the dot. Appreciate you being with us. What we're talking about are the DLP income and growth fixed notes and the incentive going on right now for about, I believe, another week, I believe to the 17th for up to 2% higher rates than we typically pay out. So really excited. And without further ado, let's get started. Feel free to use the chat box bottom of your control panel to ask any questions as we go. Type in any questions, and then towards the end, I will open up the audio for anybody who wants to ask verbal questions as well. All right, so quick overview about us. I think most people looking at the list of names recognize most of you, at least a big percentage, are existing investors, and most names are recognized. So probably not the first time anybody on here has heard about us, but just in case somebody is, I'm going to cover us really quickly. So our investment principles, which if you're on this webinar, this probably rings extra home to you. This mindset, because this is the mindset of a fixed note investor, I believe, to the T, which is no losses to investors ever. That's our number one principle of all of our investing funds and options, but certainly even more so with this strategy we're talking about today. Number two is consistency in the return. With this investment, you get paid every single month consistently, or you can let it compound and grow. And then we invest in what we know at a deep level while focusing on generating the highest returns we can without sacrificing, taking risk of loss, or any inconsistency in our ability to generate returns. A bit about us, about myself. I've been in real estate for 12 years now, going on 13 years, over 6,000 real estate closings, over $1 billion. I've purchased over 1,000 properties, currently own, actually now, I believe today, it might have just broken 7,000 units owned, over $500 million in assets along with our investors. And I am the CEO and founder of our family of companies. You can see that updated picture if you've been following these for a little while on the left. That's from Easter with my two little boys who just turned 5 and 6 years old. You can see there on the left. All right, so and then my two partners here in DLP Capital Partners is Barry DeGroot, our general counsel, and Bob Peterson, our CFO. They're both partners in the firm and big parts of our success and what we do and how we go about mitigating risk. A little bit about the Income and Growth Fund. So basically what the Income and Growth Fund does is makes loans to real estate investors. That's the really short version of what this fund does. It makes loans to real estate investors. Those investors can consist of investors who are not DLP, meaning to borrowers who we lend to, third party unrelated to DLP borrowers, as well as DLP could be the borrower, or I could be, or an affiliated entity could be the borrower. So either DLP is the investor buying the property and renovating or improving it, or it's another experienced, successful real estate investor who owns the property. And the fund is making loans to real estate investors, either making loans to where we're the borrower or making loans where another investor is the borrower. And then the other investment option you see there where it says investments into the DLP lending fund is the fund actually investing into the lending fund, which all the lending fund does is make loans to real estate investors. So it's a way that we avoid conflict between the income and growth fund and the lending fund, in that the income and growth fund will buy units interest in the lending fund, so it gets the exact same exposure to loans and borrowers and geographic locations as the lending fund. So in really short though, we make loans to real estate investors. That could be DLP or it could be another investor, which is the only fund that does that. The lending fund only makes loans to third-party borrowers. The income and growth fund can lend to the same as lending fund or to DLP as the borrower. We believe that decreases risk because we believe we are the strongest borrower that we're going to be able to lend to. And the other benefit of us being able to lend to either side is it increases our ability to keep our money deployed, to have opportunities to be able to lend and invest, which helps us increase our returns to the fund. So as a note holder, which is what we're talking about today, you are first to be paid out of the DLP Capital Partners Fund. So you are in the first position to be paid, which I'm going to explain more in a little bit. And in effect, you are in the lowest risk position of any DLP investment offering. So you get paid first, and you're in the lowest risk position out of any of our offerings. And keep in mind, in all of our offerings, no investor has ever lost any money, and we've never missed a return goal or target on a singular month. So to better illustrate that, let me show you this. I'm going to show you this little chart here. So This is actually a little bit inaccurate. I just got my marketing team just put this together earlier today. It's actually a little bit off, so I apologize about that, but it'll still serve the illustration points here. So right now in the income and growth fund, and I'm simplifying things a bit for example purposes, but let's say the value of the real estate that we have loans against is $30 million. So the real estate, the homes, the apartments are worth $30 million. The fund has about 20 million, not 22 million. That's where they made a mistake here. The fund has about $20 million in total capital invested against the 30 million. So again, apologize for the illustration, but about 20 million. So I'm going to draw a little highlighter here. So right here about is where the fund actually sits in the capital stack. So there's about $10 million of equity invested by the borrower, which could be DLP, it could be myself, an affiliate of DLP, or it could be a borrower unrelated to DLP, somebody will lend to. But there's about $10 million in this example, about a third of the money is invested in equity that's in a first loss position. It's the equity invested in the real estate. Then we have the Income and Growth Fund partners. And some of you in this meeting are partners in the Income and Growth Fund. So the Income and Growth Fund partners have about 16.5 million here. So this second area here, right here. So this is the equity investors. So if you came into the Income and Growth Fund as an equity investor to receive an 11% return, you would be from 20 million down to about 3.5 million. That would be your exposure. So there'd be $10 million ahead of you that would have to be lost before you could lose any money. Then as a note holder, which is what we're here talking about here in this webinar, you would be at only $3.5 million. That's how much value of notes is in the fund right now. So in order for a note holder to lose money, the borrowers would have to lose their $10 million here. All of the equity investors would have to lose their $16.5 million here in order for a note holder to lose 1 penny. So as a note holder right now, there's $3.5 million in notes against $30 million in real estate. That's a very, very low risk position from our viewpoint. And again, I'm simplifying this a little bit for illustration purposes, but the very short example is all of the equity within the real estate itself would have to be lost, and all of the equity investors in the fund would have to lose all of their money before a note holder could lose a single penny. So you're in the first to be paid position, sitting in front of and priority of payment above all the other money invested in the fund or by the borrower. So that puts you in a very, very good position. When a lot of people see this, frankly, some people say, well, look, being here at this $20 million level with $10 million of equity above me, that's in a pretty great position to be, which is essentially the position of the lending fund, as well as a limited partner here in the Income and Growth Fund. That's a lot of equity ahead of you, plus all of these borrowers all sign personal guarantees as well. But as a note holder, you're all the way down here, putting you in a really, really, really great position. Especially if you're, if you're wanting if you're concerned about the direction of the market or what could happen, puts you in a really good position. But again, keep in mind, all of these investors here as limited partners in all of our funds, none of them have ever lost money. We've never had losses on a singular loan, and we've been able to be in a really, really good position to generate high levels of consistency without volatility or loss. All right, so let me move here forward. Hold on 1 second. All right. So how do you get paid? What are the actual rates of return? Here are the normal rates of return as a note holder. So normally we're paying out, you'll see on the left side, you'll see two different charts on the left and the right side. So the left side here, these are the returns if you take distributions every month. This is what return you would typically earn. This is annualized returns paid out monthly. If you chose that you didn't need income and you wanted growth, you could choose to let your returns compound. And this is what the effective returns would look like, because you'd be getting compounded returns. Returns would be being compounded every month. giving you a higher overall return. You can do a combination of both. So you could say, look, I want $1,000 a month in distributions, and I want the rest to reinvest. You could choose to do that. You can set it up however you like. You can switch at any time. It's very flexible. As you'll also see, as you invest more money, the rate goes up accordingly. So as you invest more money, the rate goes up. And then as you commit longer terms, the rates go up. So this is a 1-year commitment, a 3-year commitment, a 5-year commitment. And the 1-year commitment is actually really only a 90-day commitment because you can redeem out in just 90 days. So if you want something that's pretty liquid, and also a way if you haven't invested with us to kind of test out, the shorter term notes is a great option. But you can commit for 3 years or 5 years, get a higher rate, and as you commit more money, rate goes up. If you came in today and invested $200,000 and locked in at 7% as an example, and then 6 months from now you invested another $50,000, your rate on all your money would go up to the next level. So we always give you that benefit. As you invest more money, your rates go up. And then also we give you the benefit of looking at your account as a whole. So if you had $200,000 with us as a partner in one of our other funds, a limited partner in one of our funds, and you decided to invest another $200,000 here, or let's say you invest $100,000 into a note, we would look at it that, all right, your total account size with us and all your investments is $300,000. So we would pay you at this level, even though you only had, say, a $100,000 note. Those are some of the things that we do here to make the returns even more attractive. So this is what we normally pay. This is what we've been paying out for the last few years, other than for a few weeks last year when we ran a similar incentive to what we're running right now. This is what we're paying now. So this is for 3-year notes. So if you commit for a 3-year note, normally the return, as I just showed, was 7%. We're going to pay out 8%. That's a locked-in rate that you're paid on an annual basis, locked in for the next 3 years. If you invested $250,000 to $500,000, it's normally 7.5. We're going to pay you at 9. If you invested $500,000 to $1 million, normally everything from $250,000 to $1 million is 7.5. So if you invested between $500,000 to $1 million, we would pay you 9.5. And if you went over $1 million, we'd pay you 10%. That's a fixed note locked in for the next 3 years. So this incentive is a 30-day incentive, or we bring in $5 million. Either way, this will be ending in, I think essentially it's a week. I don't have the exact date. I should have that handy, but I don't. But it's about a week from now that we're running this incentive for yet. All right, so that's how the rates work. Now, so obviously highly attractive. Again, this is fixed. Take distributions every month. Let it compound and grow. What, again, we do with the money here, here's a couple examples of properties that we've made loans in that currently have loans on from the income and growth funds. This is a property that we purchased for $5.5 million. DLP is the owner, affiliate of DLP, I should say. We need about $5.8 million to close this property between the purchase and the closing costs. We took a loan out from a lender for about $3.9 million. The income and growth put in essentially what turns out is a mezzanine or second position loan for about $500,000. Meaning there's about $1.4 million of equity invested at closing into this property, protecting the fund. It's a 128-unit community in Brunswick, Georgia. We're just finishing up renovating these 40 apartments, and we have great properties doing really, really well. And we've been driving up rents, great market, right outside of the Sea Island, St. Simon Island area of Georgia, coast of southeast coast of Georgia. So that's an example of a property that we would do a loan on, an actual loan that we've done. Here's another one, and this is actually, funny enough, in St. Simon Island. This is a 24-unit condo development being run operated as a hotel in St. Simon Island. Actually, we're hosting an event at this building next month. We purchased this property for $7.3 million. It's across the street from the beach, oceanfront. We paid about $300,000 essentially per oceanfront condo. The value is about $425,000 to $450,000 conservatively, for a total value of $10 to $11 million. We took out again about a $5.5 million bank loan. Income and growth did about $1 million loan, and there's about $1.2 million of equity in this property invested by the borrower, which is an affiliate of DLP. I am the owner of this property. So we have significant equity invested in this, plus the money we've been putting into it since we purchased it. So those are a couple examples. We also do a lot of single family loans to fix and flip investors, but these are kind of the more unique types of investments we do. These last two to kind of give you a range of what we do. Those are some pictures of that property. Really high end luxury property, pool, 24 really high end, fully furnished condos. Parking garage, etc., right on the beach. If you've ever been to St. Simon Island, it's a pretty awesome place. So with this investment option, like all of our investment options, you can invest directly through your brokerage account, Schwab, Fidelity, TD, etc. You can invest through self-directed IRAs as well, so you can use IRA money as well as cash. So with that said, it's a relatively short overview, but it's a pretty straightforward investment, which is what makes it so great. I'm just going to go back and recap it here quickly. So these are the normal rates. Here's what we're paying out right now: 8% for under 250 grand, 900 for 250 to 500, 9.5 for 500 million, 10% for million plus. Incentive goes for a few more days. Again, it's a fixed rate locked in for 3 years. Take distributions every month. Let it compound and grow. Your choice. Invest in cash or IRA, really great opportunity. So next event we have coming up here to share with anybody looking to potentially join us, if you haven't already registered, April 26th, 2 weeks from tomorrow in Bethlehem at the Blue. If you're not from Bethlehem or Lehigh Valley area and you want to join us, we'll put you up at Hotel Bethlehem or a cool place in town and come join us, meet 100 plus of our existing investors, have a good time. And then with that said, I'm going to open it up to questions you may have. Again, feel free to type them into the chat box or go ahead and ask them out verbally. I'm going to take people off of mute here now. So if you're on mute on your own phone, or your computer, you're still on mute. I'm not taking your side off, but I'm removing the control on my end. So I just did that. So you have the ability now to ask questions verbally or feel free to type them in as well. All right. Yes. So this incentive. The question is this: do these rates only apply to new investments? So yes, these rates only apply to new investments. So if you already have money with us in a note or in another investment, unfortunately, we won't be able to pay out these rates for existing capital. But it's for any new capital you invest. And again, you can invest if you're an existing investor with us and you have $500,000 with us today as an example, and you say, hey, Don, I got 50 grand free, I got 100 grand free. You can gladly do so. You can gladly invest a smaller amount. And then again, if you had $500,000 with us today, we will give you the benefit here that, hey, you had $500,000 with us today, you're going to invest another 100 grand with us now for this incentive. Even though you're only investing 100 grand now, we're still going to pay you at this 9.5% rate. So great question. All right. Next question here is related to the IRA investment process. So if you have a existing 401k from maybe an old employer, or sometimes even an existing 401k, you can do so as well. Depends on how the program, how it's structured, or certainly any IRA. You can invest potentially if you have a Schwab account or Fidelity account, you can invest right through those accounts. But what's most common is that people will roll their investment over, do a rollover or transfer into a self-directed IRA. We work with a couple different companies. There's lots of them out there, but a couple different companies that you can come in and do a rollover and self-directed IRA. We cover all your expenses, so there are no expenses to the IRA. We pay them all. And then you get a fixed absolute return. So that whole process from start to finish takes a couple weeks. If you came to us today or this week, early next week, say, hey, Don, I want to do this, but I've got to roll over money from an IRA, which again, we'll handle that whole process, make it really easy. Even if that process takes beyond the incentive, if we started the process, we'll still give you these higher rates. And then something I forgot to say that's pretty important that I just thought of here is these rates that we're showing here, here on this screen and our typical rates as well, there are no expenses that come out of these returns. These are absolute returns. There's no management fee that comes out of this. There's no administrative fee. There's no wire fees. There's no IRA fees. There's nothing. it is as simple as possible to give you a real life kind of example. If right now you did a $250,000 note with us, it's a $250,000 note with us at 9% rate. 250,000 at a 9% rate is $21,250 is what the income is. It's 9%, if my math serves me right there. No, actually, it's $22,500, I believe. $22,500 is what 9% is at $250,000. So that $22,500 is exactly how much you will earn as your gross return in year one if you take monthly distributions. If you let it compound and grow, it's even higher. And out of that $22,500, there's not a single expense that comes out of it. You will actually get $22,500 net distributed to you with not one penny that comes out of it. And to give you another simple example here, if you let the money compound and grow, and you said, all right, I don't need the money right now, and you let it grow, you can easily, with a simple calculator right now, or we can certainly do it for you, you'll know exactly how much money you're going to have in 2 years, exactly how much money you're going to have in 3 years, exactly how much money you're going to have in 4 years. To the penny, you can figure that out, which is a pretty comfortable feeling in today's environment to be able to say, hey, all right, I put $250,000 in here, and in 2 years, I'm going to have exactly X amount of money. That's a really, really amazing position to be in my opinion. And if you've never heard of the rule of 72, it's a pretty cool rule to investing. So if you look at these rates on the screen right now, the rule of 72 is if you took, say, that same 9% return, you took 72 divided by 9, that's going to tell you exactly how long it would take your money to double. So as an example, if you invested $250,000 at a 9% return, take 72 divided by 9, in 8 years, your money will have doubled. You will now have $500,000. That is the amount of money you will have if you keep your money in this investment and let it compound and grow. You said, pick another number. You took $500,000 and you invested that with a 9.5% rate. You take 72 divided by 9.5, and I'm doing the math off the top of my head here while I'm talking, but in about 7 years, a little over 7 years, 7.5 years, your money will double, and you will now have $1 million. You can really do the math that simple, and it's a pretty powerful position if you're looking towards retirement at any point in the future. So again, no expenses. All right. So one of the questions that came in: are we securing notes? So that's a good question. So everything I've been talking about here is for within the Income and Growth Fund as a note within the Income and Growth Fund. So if you are an accredited investor, which means you have $1 million in total net worth, not including your personal home, or you have a $200,000 annual adjusted gross income, you would meet the status of accredited investor. You could invest through the Income and Growth Fund. Your security then is the direct security is the fund itself. So as an example, in the Income and Growth Fund, there's $3.5 million in notes, and the fund has over $20 million. So that the direct security is all the equity in the fund. The additional security or indirect security is all the underlying properties that we have mortgages and notes against, which are over $30 million. Now, if you are not accredited, we do have a very similar investment option. We just call them fixed notes, where you would actually be doing a note or making a loan against a specific entity, or in some cases specific property that I or affiliate of DLP owns. So you're actually literally making the most simple form of investment you could make, which is you're lending money to us, backed by specific real estate that we own. So we can go through those two options with anybody in more detail. If you are accredited, which one makes sense? Usually people choose to go into the fund if they're accredited. If they're not accredited, they do the fixed notes outside of the fund. And it's the SEC who requires us to only have accredited investors within the fund. So hopefully that answers the question. If not, feel free to add more. Next question I see: do we receive a 1099 interest statement or K1? So it is a 1099 interest statement. Is what you receive for this investment. So it's not a K1, it's just an interest statement. It is ordinary income. If you are investing cash, if you're investing IRA or qualified money, of course you're sheltered from tax. But if you're investing cash, you're going to get a 1099 interest statement, and it'll be taxed like any other ordinary income. All right, next question I see here. If you commit to 3 years but need to withdraw after 2 years, what is the penalty? Yeah, great question there. So to this date, we've been managing fixed notes now for 11 years. To this date, nobody has ever paid a penalty, a fee, an expense, anything. So we kind of work in the honor system, I guess you should say, you could call it, that we tell people, look, if you're looking to lock in for a 3-year term or a 5-year term, come into it with the expectation that you're doing so for 3 years or 5 years. But if life happens, good or bad, and you need to get that money out in a year, 6 months, 2 years, anytime, we let you redeem out, and we've never charged a penalty or a fee to anybody. So we just ask that if you're going to go for 3 years, that's your plan. But if something happens, it happens, and we do not charge any penalties. Hopefully that answers that question. If not, feel free to add more. Would outside lending financial institutions have first position, or would investors in the know? Good question. So the question was, if we had a loan from an outside investor, would the fund have first position, or I'm sorry, by a bank, say, who would be in first position? So some reason right now I'm having a little bit of a problem with my my mouse. I can't get it to let me go back on slides right now. So hopefully that fixes in a second, because I would like to go back to one of the slides on one of the examples. In one of the examples I showed, if you remember, there was the example of the apartment community in Brunswick, Georgia. In that apartment community, we had a $5 million loan from a bank against that piece of real estate. And then the Income and Growth Fund had a $500,000 loan on that property in essentially second position. And then there was $1.4 million of equity invested. So the Income and Growth Fund sits ahead of all $1.4 million of equity invested. And then out of the $500,000 the Income and Growth Fund invests, over 80% of that money is Income and Growth equity investors. So all of the Income and Growth Fund equity investors, so call it $400,000 out of that $500,000, they'd have to all lose their money before a note holder could lose a penny. And again, all of the properties, all of the interest in all of the properties are essentially secured as a fund. It's not, your risk is not ever in just one property. It's across many, many, many properties. So basically all of the properties, all of the investors would have to go bankrupt and lose their money. And then all of the Income and Growth equity investors would have to lose all of their money before an Income and Growth note holder could lose a penny. And DLP Capital would essentially have to go bankrupt as well, because we're signing a note, a contract guaranteeing to pay you your return. So these returns are guaranteed by DLP. They are not guaranteed by the FDIC, but they are guaranteed by DLP. We're signing a contract to pay you this fixed rate of return. So good question there. Hopefully that appropriately answered it, but happy to dive into more detail on that as well. I think I answered all these written questions, but again, I'm having a mouse issue, so I can't go back up and read up through the chat box right now on any older questions. So I think I was answering them as they were popping in. But if I didn't answer your question, feel free to retype it in as well, because I can only see the last 3 questions that were entered in there right now. For some reason my mouse is not letting me move. Again, you're welcome to ask verbal questions as well, but lots of great typed in questions here as well. A lot of very good ones. All right, awesome. Well, it looks like I cleared all those questions. I think those were all pretty full answers. But of course, if you have additional follow-up questions you don't want to ask in this format, this is where the opportunity comes. From this webinar here today, you'll get a follow-up email after the webinar. We did record this as well, so this recording will go out as well. But then feel free to reach out to myself. You can always respond back just to the email that you get from us, and that actually goes to myself and Larry Hickernell, our Senior Investor Success Manager. But feel free to reach out to me, Larry, Bob, and we'll gladly dive into any more specific questions on the investment, the risk, your specific timing of your investment, and any other the million questions you might have, and how this works and how you would structure your investment. But it's a great strategy. When investors look at all of our options and they realize that, hey, we have other options where people are getting 11, 12, 13, 14% returns with monthly distributions, high level of consistency, it is awfully tempting to go with the 11, 12, 13, 14, 15% returns. And that's why so many people do that. That's why in the Income and Growth Fund, over 80% of the capital is equity. But that actually then makes the risk even lower going as a note holder, because you're in the first position of the capital in the fund. And in this market, and I think in any market facing some volatility, I think coming up, 8, 9%, 10% returns fixed at this risk profile is a pretty amazing place to be in my perspective. So appreciate everybody's time sticking with us here. If you have any additional questions, I'll give another opportunity to go ahead and ask them. If not, I'll wrap us up and wish everybody a great night. Hopefully I'll see many of you in a couple weeks at the dinner in Bethlehem. But appreciate all your time here tonight. Awesome. Have a great night, everybody. Oh, now my mouse is working. So this was the property I was talking about. Of course, that's the way it always works. But I'll just go back to that slide if you're still hanging with me to what I was referencing here. About the values here. So I guess that wasn't that last slide. So $5.5 million purchase price, $3.9 million loan, $500,000 from the Income and Growth Fund, $1 million for equity. So $1 million for sitting behind the fund, or in risk above the fund, and then most of the money from the fund is from equity within the fund. So you are sitting in this specific property behind the loan from the bank, but ahead of $1.4 million plus an additional most of the $500,000 as a note holder. And then since we bought this property, over $1 million has been invested in equity to improve the property and renovate these 40 apartments as well. So awesome. Thanks, everybody.